What if I told you there's a brand new mortgage loan in 2025 that lets you buy an Airbnb property with only 10% down, and you can qualify using both your personal income and your rental cash flow? No W 2 required or strict documentation. This is a game changer for Airbnb investors, and I'm about to break down exactly how it works. Hello, I am Jason from Truss Financial Group, and today I am introducing to you our new hybrid short term rental loan designed specifically for Airbnb and vacation rental investors. In this explainer, we'll dive into what this loan is, how it works, who it's for, and why it could be a huge win for Airbnb hosts and investors. By the end, you'll see why this financing model is making waves and whether it might be a fit for your next investment property. First, what is this new hybrid STR mortgage? In simple terms, the hybrid STR mortgage combines the best features of a traditional home loan with the flexibility of an investment property loan. STR stands for short-term rental, which means this loan is built with Airbnb-type properties in mind. Unlike a standard mortgage, which focuses only on your personal income and W-2s, or a pure DSCR loan, which cares only about the property's income, this hybrid approach uses both your personal income and your short-term rental income to qualify. It essentially bridges the gap between conventional and DSCR financing by considering the whole picture of you and the property. DSCR, or debt service coverage ratio, is a term many investors might know. A DSCR loan lets you qualify based on a property's cash flow. Lenders check if the rental income can cover the debt payments, and if so, they often don't even require traditional income verification like tax returns or W-2s. That's great for full-time investors with strong rental income, but the downside is DSCR loans ignore your personal income or assets entirely. On the flip side, traditional mortgages, think Fannie/Freddie loans, rely heavily on your personal income, pay stubs, W-2s, debt-to-income ratio, etc., and often ignore potential rental income from an Airbnb or limit how much of it counts. The result? In the past, a lot of profitable Airbnb owners fell through the cracks. They made great money on rentals but couldn't qualify for a loan because they lacked a conventional income profile, or they lived in part of the home and thus didn't fit the DSCR mold. That's changing right now. The new hybrid STR mortgage from Truss Financial Group combines both worlds, giving you the stability of a conventional mortgage and the flexibility of a DSCR loan in one package. Put another way, it's a dual underwrite loan. Lenders evaluate you two ways: traditional, your personal credit income, and DSCR, the property's income, and then blend those together for approval. This means you can finally use your Airbnb's cash flow and your personal earnings together when applying, something unheard of with old loan programs. According to Truss Financial Group, the hybrid STR program is built for today's reality, where homes are both places to live and powerful, income-producing assets. How does it work? Think of the hybrid STR loan as two loans rolled into one approval. Here's a breakdown of the dual qualifying process. Personal income review. Lenders still evaluate your personal income, credit score, and debt-to-income ratio, DTI, just like a traditional mortgage. A credit score of around 680 plus and a DTI below approximately 43% are typical benchmarks. This part ensures stability and gives you familiar benefits like long-term fixed rates and predictable payments. Property income review, DSCR. At the same time, the lender reviews the property's projected short-term rental income, often using verified data from Airbnb, Vrbo, or Rabbu. They'll calculate a DSCR, debt service coverage ratio, to see if the expected income can cover the loan payments. Generally, a DSCR of 1.0 or higher is preferred, but if it falls below that, borrowers can make up the difference with liquid assets such as savings, brokerage funds, or retirement accounts. Instead of a fixed ratio between the two methods, the lender looks at the overall picture, your financial strength, and the property's performance. If one side is a little weaker, the other can balance it out. This flexibility is what makes the hybrid STR model so powerful. It adapts to both your income profile and your property's earning potential. Once these two analyses are done, the lender blends them together to make a final decision. In practice, this blended underwriting means even if one part is a bit weaker, the other can compensate. For example, if your personal income is modest but the Airbnb income is fantastic, high occupancy and rates, the strong cash flow can boost your application. Conversely, if the rental income is decent but not stellar, a high credit score or other personal financial strengths can tip the scales. The end result is a more flexible approval that sees the full picture, your creditworthiness and the property's earning potential together. This is why we call it a hybrid loan. It merges two approaches to give short term rental investors a fair shot at financing. Why is this innovation happening now? One big reason is data. The short term rental market has matured to the point where there's now years of reliable income data available from platforms like Airbnb and Vrbo. Lenders can pull verified stats on occupancy rates, seasonal trends, and revenue, giving them confidence in a property's projected income. A few years ago, this kind of third party data wasn't as accessible or trusted. Now, in 2025, with companies like Rabbu or AirDNA providing solid analytics, lenders are finally comfortable incorporating rental income into underwriting in a serious way. This data revolution, combined with investor demand, set the stage for hybrid STR loans to emerge. And it's arriving just in time. Many investors are eager for higher leverage and less red tape, which this loan delivers. For instance, only 10 to 15% down payment required, up to 85 to 90% LTV financing. Who is this loan for? The hybrid STR mortgage isn't for every situation, but it's perfect for certain types of investors and host owners. Generally, it shines for people who straddle the line between being a homeowner and being a business owner/landlord. Here are the people who can benefit the most from this 2025 innovation. Live and rent Airbnb. Hosts, do you live in one part of a property and rent out another part on Airbnb? Maybe it's a duplex, a basement suite, or an ADU in your backyard. In the past, traditional lenders wouldn't fully count your Airbnb income since it's an owner-occupied home, and DSCR lenders wouldn't lend if you lived on site. This hybrid loan fixes that. It lets you count both your personal income and your rental income towards qualification. This means house hackers and live-in hosts can get better rates and higher loan amounts than before. Investors with mixed use or ADU properties, maybe you're turning a garage into a rental unit, or you have a property that's part vacation home, part rental. Hybrid STR financing recognizes these dual-purpose properties. It's one loan that allows partial occupancy and variable income use under the same roof. For example, if you have a small storefront or office attached to a home or a guest house you sometimes use and sometimes rent, this loan will factor in both uses. It's ideal for investors expanding into multi-unit, mixed-use, or ADU-inclusive portfolios who couldn't get full credit for those scenarios with one-dimensional loans. Self-employed borrowers with strong assets but variable income. If you're self-employed, a freelancer, or a gig worker, you know the pain of traditional mortgages. Irregular income on paper can hurt your approval, even if you actually make good money. With a hybrid STR loan, lenders take a more holistic view. They'll look at your personal financials, even business deposits, assets, plus your rental income to paint a more accurate picture of your ability to pay. In fact, this is one of the first loan types that fully acknowledges both your personal hustle and your property's performance in underwriting. So, for entrepreneurs or consultants who write off a lot on taxes, making their income look smaller, but have profitable Airbnb units, this program can be a lifesaver. Seasonal market investors in vacation destinations. Short-term rental income isn't steady year-round in many markets. Think ski cabins or beach houses where the cash flow swings by season. Traditional loans might not give you credit for those peak season earnings, and DSCR loans might undervalue off-season periods. The hybrid loan, however, can consider annualized and seasonally adjusted income, which gives buyers in places like Florida, Arizona, or Colorado more breathing room to qualify. In other words, it acknowledges that a property might make a killing in the high season and slower in off-season, and it balances it out. If you're buying a vacation rental in a high-demand state with big seasonal tourism, this loan could let you borrow more than a strict DSCR loan would. Bottom line, the hybrid STR mortgage is tailored for a new generation of real estate entrepreneurs who blur the line between personal home use and business use. It's for homeowners who think like investors and investors who also want the comforts of a home. If you find yourself in any of the categories above, this could be the financing tool you've been waiting for. If it sounds intriguing, don't hesitate to reach out to us at www.trussfinancialgroup.com for more info or to start an application. Happy investing.